to our Actuaries Institute webinar on managing capital in a COVID-19 environment. I know we've still got some people coming in, but I thought we'd start reasonably on time so that we can make the most of the hour we have. First of all, I'd like to acknowledge the traditional owners of all the lands across Australia and New Zealand on which we're gathered and pay my respects to their elders past, present and emerging. In particular, I acknowledge the Cammeraygal people of the Eora Nation on whose traditional lands I'm speaking from. Today is a webinar to give you a briefing on managing capital in a COVID-19 environment, which has materially impacted the operating environment of all of our regulated institutions. This insight session will discuss high-level capital considerations relevant to actuaries advising boards in the context of COVID-19. So today, June the 16th, is exactly 2 months since our first COVID-19 webinar. There have been over 430,000 deaths officially counted around the world from COVID-19. There have been nearly 8 million recorded positive tests. In Australia, there have been just over 7,300 positive tests with 102 deaths. And in New Zealand, there have been 22 deaths with around 1,500 confirmed and probable cases. New Zealand has declared the virus eliminated and has reopened up internally, and several states in Australia are in a similar position. The Australian ASX 200 index dropped by 30% from 31 December to late March, but is now backed up to only around 15% off the 31 December peak. And the 10-year government bond yield is still under 1%. So this webinar is around the pandemic briefing note that's on the Pandemic Resource Centre. So I'd encourage you all to have a look at that if you haven't already. Before I hand over to our speakers, a quick note on the context. The board is responsible for ensuring that their regulated institution holds capital commensurate with the risk profile, and that institution has a board-approved internal capital adequacy assessment process. ICAP involves an integrated approach to risk management and capital management, and COVID-19 has materially impacted the operating environment of regulated institutions. In these uncertain times, boards will need to review their business objectives, risk profile and risk appetite, and will turn to their ICAP to help them manage this crisis. So that's the context for our webinar today. And I'm now going to ask Tim to put up the agenda and we'll talk through what we have on the agenda. Thanks, Tim. So the agenda today, we're going to talk about process and agenda requirements from Tim Clark, business objectives and risk management from Paul Nuttall, capital forecasting and target surplus from Daniel Longden, and then back to Paul with the ICAP self-assessment. And then finally we will have a discussion and Q&A from anybody who would like to ask a question from the panel and also questions along the panel. So during the presentations, please use the chat box to raise questions or comment. We will have a chance for Q&As following each presentation if there's particular questions that seem relevant to those presentations, and then we'll have further discussion and Q&A at the end. So I'd encourage you all to, as you go, have a look at the Q&As and see if there are questions that are relevant to your questions you'd like to raise, and also at the end. So now I'm going to hand over to Tim Clark, who has been leading the capital stream as part of the GI working group. He's Global Head of Actuarial P&C for Swiss Re. Over to you, Tim.
And thank you very much. Hang on, I'm controlling the screen and my presentation as well. So just as Jennifer said, APRA does expect us to be dynamically using the ICAP throughout the pandemic and the following economic situation we're going to find ourselves in. And the ICAP is that relationship between capital and your financial risks. How you use the ICAP through the crisis and how we make sure it's fit for purpose is the subject of the note that we spoke about. The note does contemplate many companies using a range of scenarios, dynamic scenario analysis, to manage the liabilities, to manage the assets, the capital, and the future capital needs. All of them are going to be put together in kind of this dynamic scenario analysis. And that's a process where you set out a range of scenarios of potential futures and what risks and what strategies and what business plans would play out in each of those scenarios. And then you've got to coalesce them together to actual actions the company's going to take. You'll find that under each of the scenarios, very different capital needs and capital requirements might play out, different business strategies. The directors and the note suggests directors have to be strongly involved in the governance over the scenarios at various levels. the governance over the scenario generation and monitoring is important. The directors have to gain an understanding of the uncertainty which their entity is faced under each of the scenarios, because they're very different to what you would expect in a normal environment. That communication around the uncertainty, don't follow the little graph here and try and do it through mathematics and the usual way of doing it. In fact, we're considering in the company I work and where we work, before we actually give numbers, to actually ask for how these numbers are going to be communicated. So the notes to the accounts, how you're going to put it in your FCR, that communication is going to be equally as important as the number, because we've got to change the mindset that as actually Nicola Rubenstein mentioned last week at the AICD conference on this topic, that the actuaries were describing things as their best guesstimate. And she was comfortable with that, and she was able to communicate that through the board, that we are working in a very uncertain world. Organisational agility is mentioned very briefly in the note, but it's going to be quite crucial, because you're going to start down one path, and if we get a second wave, either locally or globally, maybe you're going to have to react and shift more likely to scenario X rather than scenario Y. So that organisational agility will be crucial. The note steps through the steps that you take under each of the scenarios, and that'll be for my other learned colleagues to speak through. But that's all I wanted to say at this stage, Jennifer.
Thanks, Tim. I'm now going to hand over to Paul Nuttall, who's looking at stress and scenario testing for the working group, the COVID-19 working group, and as well as has been helping look after the content of the Pandemic Resource Centre. Paul has ICAP experience in a major bank. He hastens to add it's pre-COVID, but I think that the experience of working in ICAP in an environment with a lot of different scenarios that can happen has stood him in good stead in working through this process. So I'll hand over to you, Paul. Paul, you're on mute.
Sorry, I should know better. Apologies for that. Thank you, Jennifer. Thank you, Tim. Thank you for reminding me that I was on mute. For each of the scenarios that Tim has discussed, companies would want to think about, well, what's the economic and competitive environment that they're in? And how does that impact their company strategy? Their strategy may well be very different for each of those scenarios. And what are their business objectives in the short term, the medium term, and the longer term? And how flexible is their business, and how flexible does it need to be able to pivot, as Tim was saying? Because you may be moving from one scenario to another. What's the current company's risk profile? And how is this changing? What's the assessment of its risk? What's known and what's unknown? Both are very important. Is the current risk reporting working? And is it appropriate? Will it detect changes in the risk? And is the risk profile within the company's risk appetite? And if not, what needs to be done about it, and how quickly? Does risk need to be reduced? Does more capital need to be held? Or does the board want to change its risk appetite? Is risk mitigation working as expected? And overall, is the risk management framework fit for purpose? And I'd recommend, if you're interested, having a look on the Pandemic Resource Centre for a pandemic briefing on risk management. In fact, there's two. There's one for management and one for non-execs that provides more information in this space. So, thank you, Tim. Moving on to the current capital position. Well, what is the current capital position? We have lots of different metrics for capital. There's common equity tier 1, total capital, leverage ratio if you're a bank as well. And then there's level 1, level 2, level 3. So multiple metrics, multiple scenarios, multiple time periods. It's very easy to create a lot of confusion. So where do you focus the attention in terms of capital metrics? Where's the uncertainty in the capital assessment? On the asset side, do you have unlisted assets? How comfortable are you with the valuation of unlisted assets? The derivation of the risk margins and all the issues with that, and the liability calculations. In terms of the risk and uncertainty, well, what's factored into the best estimate assumption and what's factored into the risk margins? And are they consistent? Which assumptions are the most important? And how sensitive are they? Are there any asymmetry or tipping points in those assumptions that you'd want to bring out to the board and others? Are there other risks that hadn't been considered before? People have been talking about cyber security risk from people working at home. What's the impact of that? And is the capital reporting working? So the right people getting to see the right information. Is new information required, or is less information required, which at times can be almost as important? Thank you, Tim. Is the company operating below its target surplus? And what actions does ICAP recommend in this case? And are they still appropriate? You'd want to start by looking at ICAP, but you wouldn't want to just then blindly apply those actions. They may not be appropriate. There may be new ones that are better. Are those actions working as planned? And what have you learned from that respect? Is the trigger framework working? The reporting, the actions, the early warning indicators, are they timely? Are the right people, again, seeing the right information? How easily can capital be moved around the group from parent to subsidiary? Are there any traps? Different legal entities, different jurisdictions? Is there any impact from liquidity on capital or vice versa? What's the impact of a credit rating downgrade? Either to your company, to your parent's company, or maybe more importantly, to a reinsurer, for example. And at what point does the credit rating downgrade become significant? You know, 1 notch, 2 notch, 3 notch downgrade? Again, are there any tipping points in that respect? Thank you.
So, thanks, Paul. Is that the end?
That's it. Thank you.
That was the end of that section. I'm now going to hand over to Daniel Longden, who's been the key life insurance representative on the COVID-19 working group and is also a partner at KPMG. And I should say that Tim, Paul and Daniel are the key people who've put together the pandemic briefing, so absolutely the right people to take us through it today. So over to you, Daniel.
Thanks, Jennifer. I just wanted to illustrate the couple of points I wanted to make with a very simple example. So I want to start just considering a life insurer here that's got basic assets equal to its target surplus and prudential capital requirement. So pre-pandemic, distributed down to target surplus. So if we then consider a scenario having the pandemic hit and 3 potential reactions. So we'll look at now 3 identical insurers with different reactions. So Insurer A has determined that no changes to best estimate assumptions or risk margins at this stage, and no changes to target surplus policy. For this insurer, any changes in claims experience, which is a key consideration for a life insurer in terms of pandemic impacts, is going to come through and emerge as an experience item in the short and long term. Insurer B takes a different approach and decides that there's some impact on short-term claims, so increases best estimate assumptions and also increases risk margins given the increased uncertainty. That flows through to an increased prudential capital requirement and some consequential increase in target surplus. So this insurer is now operating potentially in the amber zone in its target surplus policy. Third insurer, so again identical, Insurer C, determines a slightly different approach. So no change to best estimate assumptions and risk margins from a prudential capital requirement, but determines that given the increased level of uncertainty around some of the assumptions that it's using in future scenarios, that it's increasing its target surplus.
Have we lost Daniel?
Requirement. So again, the amber and Insurer B has dropped.
Sorry, Daniel, we lost you for a moment there as you were talking through Insurer C. So maybe if you can take us through Insurer C again.
Can you hear me? Can you hear me now? I'm back. Yep. So Insurer C got greater impact from a target surplus, so greater target surplus impact, but leaves it with greater margin over PCR. So the simple question is, which of these insurers is most able to withstand the pandemic shock? And obviously, trick question from this, they're all exactly the same. They've all got exactly the same asset base. They've all got exactly the same risks that they're facing. So with the information we've got here, then there's no difference in terms of ability to withstand the shock. What we need to look to is the actual underlying actions that the insurer is taking and how its ICAP is operating. So if we think about what the insurers should be doing, each of these insurers, whichever initial approach they take, needs to be looking at different capital scenarios and forecasts. So what will happen? What are the key sensitivities? What are the key assumptions which will determine the future capital position of that insurer? Understanding which of those assumptions are most likely to impact the capital position, which ones are likely to trigger actions, and what actions should be taken, and what the effectiveness of those actions is. So if we consider again a life insurer, then key consideration for a life insurer at the moment is what will happen to morbidity claims. What's the impact going to be of a claims shock coming through resulting from both unemployment and mental health issues in the community? So if you consider an ICAP, then if I looked at insurers' ICAPs, most of them would have some reference to economic assumptions, most of them have some reference to unemployment rates. What they may not be referencing is the exact shape of the unemployment shock. We've got a shock here which has come on very suddenly, but unclear as to what the recovery path will be. We've got an overlay of government stimulus and other measures. We've got deferrals of business loans, personal loans, mortgages, so different impact from unemployment as you would normally see through a recession. And then we've got an overlay on mental health conditions. So unemployment and the consequential mental illness and mental health conditions relating to that. But also here we've got lockdown and we've got the additional stress and overlay from the restrictions on people's personal mobility. So if I looked at ICAPs, then a couple of these items would have been picked up. The exact scenario we're facing now wouldn't be described in anybody's ICAP. I think the key message of this is the ICAP should be triggering both actions and responses and considerations. In its simplest form, those actions would be notification to management, to the board, potentially to regulators of different capital triggers being breached. There would be triggers for putting together scenarios, putting together capital forecasts, looking at actions and formulating different action plans. If the ICAP has actually triggered those actions at this point in time, then it's probably working effectively. If it hasn't triggered those actions, then maybe there's questions around its effectiveness. If the ICAP doesn't set out an exact playbook for this particular scenario, then that's not necessarily a shortcoming in the ICAP. What the ICAP should be doing is triggering these considerations, debates, modelling, and exploration of different actions that the company may take. The effectiveness of the ICAP ultimately then comes down to what actions it does trigger, what it does prompt the company to consider, and the level of analysis and ultimately forward-looking actions that are taken. In terms of the self-assessment of that effectiveness, I'll hand back over to Paul.
So, is ICAP working as expected? Now may not be the time for the sort of a full review of ICAP, but I think it's useful to review it as you go and do a full review later on. So what worked well and what didn't work? Did triggers work as planned? Were early warning indicators appropriate? What additional reporting was used? What wasn't used? And what was a distraction? Did risk and capital mitigants work? Could markets be accessed, for example? Did governance, reporting and actions accord with ICAP? Did the right people get to see the right information in a timely fashion to make the right decisions? Is ICAP process and the document fit for purpose? Really, what changes are required? Are we talking about fine-tuning, or is it really a major rewrite of ICAP? And when I mean ICAP, I'm talking about the whole process and the document. I'll hand back to Jennifer.
Thanks, Paul, and thanks to all our speakers. Now, I haven't got any open questions in the Q&A yet, so now's your chance, all of the 100-odd people who are watching us, to give us some good questions. But in the meantime, what I'll do is I'll start with a couple that have occurred to me that we've talked about beforehand from the presentations. And I guess the first one probably goes to you, Tim. What do you think are the most important things that we should be thinking about when we look at the scenarios that the board is using? So how should the board think about what scenarios to choose, and how should the actuary who's advising the board think about what scenarios to use and how to measure them?
Okay, so it's quite important in that governance process that I spoke about to think through, the role of the board and the role of management. And in my mind, I see the role of the board to understand the macroeconomic environments that they really want to explore. So they should be setting out, maybe they're getting advice from an economist or an immunologist as well, how long and how likely do they want to consider, what ranges of pandemic health issues do we want? Second waves, third waves, local and international would be characteristic of scenarios they look at, or characteristic across all the scenarios they should look at. How long is the economic crisis going to go for? How long is the monetary and fiscal stimulus going to keep coming locally and internationally? Locally, you'd want to kind of translate that into inflation assumptions, GDP assumptions, unemployment assumptions. For general insurance and probably life insurance, you'd want to have insolvency assumptions. And then perhaps in your scenario, defined at the board level, would include something around geopolitical impacts. You've seen the kind of increased tension between China, the US, and maybe China and the rest of the world, and how that plays out in your supply chains or future business cases. So that's the kind of level I think a board level governance of the scenario should be. Then they should also understand the frequency and the monitoring that comes back to the board about whether we're going to push harder to scenario A versus scenario B. There's one final board level component, I think. In those macro environments, the board might want to give management a steer. If this is playing out, if it's going to be a 24-month pandemic and it's going to kill Spanish flu type outcomes, well, actually, management, your job is to keep the company into survival mode or make sure all our policyholders get paid. Where it's a less severe one, boards might want to say, actually, we want to make sure we're keeping the customer franchise alive and we're willing to take some short-term P&L pain. So that's the kind of level of guidance management that should be receiving from the board and the macro scenarios. Then it's up to management within the scenarios to get more granular about how it plays out. And if economic unemployment's running at this, then I expect my disabled life reserves to move out by this. So I put all the granular detail underneath. So that's how I see the board level's responsibility and then the management's level's responsibility.
Thanks, Tim. I think that makes sense. And I guess one of the things that I've seen playing out in different companies is also just the business environment in terms of sales and potentially in some lines of business exclusions and whether they're actually able to be operated or not. So some of those scenarios are also quite important from a capital perspective, I would say.
Yeah, but I think that's for management to bring back to the board the uncertainties within each of them. It's not really for the board to get into the granular kind of how does the Quarantine Act play out, or how does an exclusion for something or other in the life insurance policy play out. That's management to advise. But the board needs to be aware of the uncertainties in that interpretation, because again, back to the communication, each of these are going to be quite contain lots of unknowables and ambiguities in there.
Yeah, absolutely. But I guess one of the key questions is just making sure that we think about the whole business that is impacted, not just the economic and claims environment, the whole.
Sorry, to Paul's point, I think you do a mini ICAP in each of the scenarios. You don't do a full whole hog one, but that includes the business strategy and objectives in that scenario, and then all the subsequent kind of risk and capital considerations you put underneath it.
Before I go to the Q&A that I had a question for Daniel, but which we might come back which would be interesting to see whether you've got an initial response to. Your companies A, B and C, is there a view from the auditors or just generally from the various practice committees about where we should end up, or are all of those potential responses to your current liabilities and your current capital position reasonable in the current environment?
I think at the moment there is a range of views. So certainly there's been some surveys around what people have done with best estimate assumptions and risk margins in terms of response, and that indicated the range of some people already making adjustments, both at best estimate assumption level and risk margin level. Others not making adjustments at this stage. I suspect there's a degree of correlation there between proximity to a reporting date and whether people are making adjustments. So I'd expect, my personal feeling would be I'd expect more to be making some adjustment as they get to a significant reporting date.
So yeah, I guess one of the questions from our attendees, and so far all anonymous, but possibly for year-end reasons, are insurers starting to revise regulatory capital risk margins, or is it too early? What do you see from Daniel, and then maybe also from you?
Yeah, certainly from a life insurance perspective, I'm certainly aware of Sunderland reviewing capital risk margins and best estimate assumptions, and that came through in the survey, I think.
Tim, what's happening in the general insurance side?
In general insurance, we actually have a few working parties on this topic, and Jefferson Gibbs is leading it. The most important thing the risk margin working groups come up with is you need to be consistent in how you calculate your best estimate, your risk margin, your PCA, and your surplus capital. So there's got to be consistency of process in there. And we are thinking about how to do that and how to do it consistently. The outcome of that working party is not. It's a working party still in progress. So,
and I guess one of the questions that's come out of that is if you do have a different approach to estimate and or regulatory capital risk margins, you may have a different outcome in your ICAP, which I can see why that might happen. But I also think that, Daniel, your point was that the point of the ICAP is to trigger action, not necessarily to decide when you change your assumptions. So I guess, do you think that might happen, that it would change the actions triggered by an ICAP if you have different choices on assumptions?
I think, again, it's a sort of simple example, and one of the issues that life insurers are grappling with is how sensitive will morbidity assumptions be to the economic shock and the prevalence of mental illness conditions that may lead to. So I think that's right. What the action may be, if you don't change assumptions, maybe that it triggers additional monitoring of lead indicators, or looking for correlations in terms of external data that you can use to try and better predict what may happen in claims experience. So I think it's at that point the ICAP is a framework to trigger actions and responses, and one of those responses may actually be increased monitoring rather than the change in assumptions.
And I guess I'd add to that, and I might ask Paul to comment on this as well, that one of the things we're talking about here is there's assumptions for best estimate, there's risk margins, but then there's also scenarios. So all three of those need to be considered together, so that your ICAP may ask you to do some scenario work that may trigger an action, even if you haven't changed any of your assumptions. But Paul, I wondered if you had any comment on that.
My comment is to almost look at a collection of results. So you might have a view of the world, but then you've got some scenarios around that, outcomes, and then when you look at that, decide on your actions to say, based on those possible outcomes, some more favourable than the others, when is it best to take action? In terms of, if you're looking to do a capital raising, for example, you have to decide when to go to the market. And some of those scenarios may point you towards that, others may not, but then you need to look at them collectively and also look at what everybody else is doing in the marketplace.
Yeah, I remember a long time ago in a different scenario, somebody commented to me that every single bank's answer to how they would deal with a particular issue was, we'll sell New Zealand business, which obviously wouldn't work if every time. So, I don't know if that was ever true, but it was it's an interesting point. You've got to consider the whole market, not just what you as a company might want to do.
Want to be the first to raise capital.
Yeah, that's right. So I guess that comes to the other question here, that's given these scenarios are guesstimates, what's the requirement to act on the potential capital impacts that may or may not play out in future? Paul, do you want to comment on that? And then I might ask Tim.
Sorry, could you just explain what are the requirements?
Well, given the scenarios are guesstimates, we don't know what's going to happen. Do we have a requirement to act on potential capital impacts that might happen or might not happen? I guess is my interpretation of the question.
Well, that comes down to the board, and I suppose again its appetite and the likelihood it feels for those scenarios, and when it feels is the right time to act. I don't think there's a precise answer to it.
Tim, what's your view on that one?
I'd support that. I think one of the outcomes you'll find in managing through is actually more frequent interaction with the board. Now, an idea of risk appetite is to bound what management can do within a framework, and it, kind of give freedom to act within that framework. Where you're in a circumstance where we've got so many potential futures playing out, the board can't describe a risk appetite that gives management kind of freedom to act in 90% of cases. So management's going to find that they've got to be coming back periodically to, or much more frequently to the board with, actually, we thought it was going down this scenario, we thought the economic situation was going to play out like this, we're seeing it morph to this one. So how do you want us to go, board? Here's the range of things we're thinking about in this environment. I think you'll find that in many of the environments, there'll be quite a correlated series of management actions. So raising some capital, always a good thing to do. But you might, if you're looking for 2 billion of capital, you might only go 500 million in stage one and keep monitoring closely, and then step into a stage 2 one if things keep progressing down that particular scenario. That's how I perceive it to play out.
And I think it depends a little bit also about what's the outcome of some of the scenarios. If the outcome is dire, then you're going to want to take action even if you don't nearly necessarily expect it to happen. Whereas if it's an okay outcome that the company is survivable, you might be willing to wait a little bit longer before you took action. Correct.
Yeah.
While I've got you, Tim, the other question that's kind of related to that is how do you describe your best guesstimate in a formal document? Which is a tricky one, I know.
I just told you your best guesstimate. No, so I haven't had to draft it yet, but and we have set up a discussion forum today on the back of last week's discussions with the General Insurance Committee about how we're going to go about doing that piece. I would envisage describing the scenario and the kind of the middling scenario that you've adopted to calculate your numbers on, but then describe the range of, but if scenario a very pessimistic or a very optimistic one, they could move by this amount, is the way I would look at doing it. So I would not try and put this is a central estimate. That's why I would use a word best estimate rather than central estimate type language, because that communication is going to be quite important, and the 75th percentile is the 75th percentile within this scenario, and I've subjectively increased it to X because of the potentials coming out of the other scenarios. But trying to probabilistically weight it and do it in a mathematical way, I think you'll get yourself quite. Don't want is for board and management to take quite a deterministic view on your numbers, like they might have 12 months ago or 24 months ago, and they're accustomed to. Actually, this number's got a lot more uncertainty in it than the historic equivalents. If you fail in that piece of communication, the company's going to be in problems, or the entity.
Yeah, and I think reinforcing that, because some of the conversation in the AICD forum last week was very much about how important communication is in this context.
Yeah.
It's tempting for the receivers of the communication to take it as this is the answer, but the important thing is for the actuary to communicate as best possible how much uncertainty there is around the answer.
And to some degree, I think the governance process around the scenario generation and monitoring should really enforce that. That's why it was so important for us to put that in the note, because you're going back to the board frequently, monitoring things. So the economy's going this way, or the pandemic's coming a second wave. So by forcing that monitoring, you're already creating the kind of awareness of the uncertainty in the board's mind. Mind you, most of the board, I think, are pretty aware of the situation. So,
well, I think all we have to do is watch what's happening in the general understanding of the pandemic to realise how much uncertainty there is, and we're just adding to it in insurers, I think.
Yep.
I'm going to switch to you, Daniel, because there's obviously a lot of interest in your different scenarios for exactly the same company. So the first question here is for the scenarios where companies increase capital directly as part of policy liabilities or through the target surplus, what would you do before you notify APRA? Does it mean that you weren't using your ICAP properly beforehand if you didn't estimate this, if your exposure to pandemic risk was there and not appropriately quantified? Would it depend on the amount of capital? Just a little bit more about those scenarios and how you should think about them.
So I think that goes to a couple of points that have been raised. It goes to the operation of the ICAP and target surplus. So target surplus is there for exactly this sort of scenario. It's a buffer for extreme shock events. So I think the key consideration is what are the triggers in there in terms of notifications. So that may be internal notifications and actions, calling board meetings, recovery plans. There'll be triggers. Every company would have particular trigger points where they notify the regulator, which may be at different levels, and may depend on access to additional capital from parents or relying on other external means to raise capital. So I think it does depend on the individual company circumstance. I think again, actually seeing a shock come through is not a failing of the ICAP. Being able to react to that shock and withstand that shock, if it falls within your risk appetite, is the ICAP and target surplus policy actually working as it should? In terms of the feedback loop, then does it inform that the scenarios you've considered may not be as extreme as were considered, as assumed? Is the combination of events here something that wasn't actually contemplated in the scenarios and risk appetite of the company? Then I think there's a feedback loop there to work out whether it suggests changes. But actually just seeing a shock and an increase in capital requirements after that comes through is not a failing. It's a reaction to that, which is the test of the ICAP.
Yeah, I think that makes sense. I've had questions from people about why we didn't get the pandemic reserve right. From non-actuaries, and I think the answer is that there's many different ways a pandemic can happen, and that was particularly in a life insurance context where I think the disability income expectation of experience based on unemployment is bigger than people were originally anticipating. The disability income experience was more about morbidity arising from the disease rather than unemployment, but I think you can't get every scenario right. Sorry, Daniel, you were going.
I'm going to say, obviously, the impact of this has come out completely different to you'd expect anybody who's modelled a pandemic in terms of minimal mortality impacts, but unknown at this stage, but potentially significant morbidity impact. So you'd say that stresses scenarios, you come out of this testing different scenarios and essentially contemplating different types of reactions from governments in terms of how they will manage a pandemic scenario and flow on to second order effects.
I guess
you have to look around the world as well to see how this could play out differently if you were having this conversation in the US or the UK as opposed to Australia.
Yeah, absolutely. The other kind of related question to this is whether adding margins at the moment is a bit pro-cyclical. So this is a debate that I think the regulator had when they first set up the pandemic reserve, but also we continue to have is it appropriate to increase your risk margin because we obviously do have greater risks, or should you be thinking about your target surplus? I guess comments from Daniel, but also from Tim and Paul, if you have them, on how do you deal with that when we're at their worst case, we want more, not less capital.
I think there's sort of two elements to that. I think the first point is the point that Tim raised, which is key here, is making sure that you're consistent in how you deal with the three layers of your capital. So what are you taking up in best estimate assumptions? Then how does that interact with risk margins? And then how does that interact with your target surplus? So even before you get to the counter-cyclical argument, it's quite counterproductive if all you're doing as a company is setting yourself the most extreme end of what you may consider a best estimate range for assumptions, putting extreme risk margins on top of that, and then setting a higher target surplus policy. Then what you're doing is setting yourself a much higher capital target to jump over, which may not necessarily reflect the risk, and be appropriately managing the capital position in terms of the buffer that the target surplus etc. represents. So I think being consistent across the three layers is key. Then there is a consideration, particularly of how you set maybe target surplus policy in terms of a scenario of a target level of sufficiency in terms of where we are in the cycle. So, are you reflecting in best estimate assumptions you've already built in? Let's call it you're at a 1 in 100 point from a morbidity shock. So what does that imply in terms of the level of sufficiency that you're looking at in your target surplus or risk margins? So again, the interaction between them needs to be considered. Tim?
Paul or Tim, on that pro-cyclicality question?
So I think about capital, your buffer capital, kind of in two ways or two stakeholder lenses. One is the policyholder lens and the guarantee we've issued to policyholders. And I think if you're getting challenged on that level, survival of the company, then you've got to do whatever you need to do to secure your policyholder obligations. That's your first and foremost. If you're playing kind of away from your policy risks to policyholders and you're playing around with risks to shareholders, your franchise value, then you've got to take a very kind of market-wide view to it, because as Paul said, if we're all AAA rated companies and the whole market, like it did through the GFC, almost all players got migrated down a notch or two notches. Actually, AAA is kind of a very expensive luxury now when all your competitors are running at AA- or something like that. So your board needs, in that situation, to think about how comfortable it is allowing that degrade, because it's competitively neutral. So it's a very different type of set of questions depending on which scenario or which outcome your company's sitting at. So I think that's the point I'd make.
I'd add to that I think at times pro-cyclical capital requirements can have some unforeseen outcomes. And not just sort of risk-based outcomes. And in that case, it's good to call it out. But I also see that that's one of the reasons for the buffer, and that you use the buffer in those circumstances, because the capital requirements will go up as the risk goes up. That's the nature of the rules. So call it out, make it clear to the board and to the regulators in all those circumstances.
The note does refer to a letter from APRA to ADIs and insurers from the 7th of April, which does set out APRA's expectations. Now, they're one of the expectations the board has to manage, but it is have comfortable capital and don't spend your capital unwisely, and dividends are included in their unwisely view.
Yeah, and I think the part of this conversation about pro-cyclicality is very much about, again, the importance of communication, because all of those three things together need to be considered at the same time. So having margins at every point is probably not what you need, but having enough margins for the security of the policyholders and then the risk appetite around the shareholder is really important. Daniel, I might go to the question on reinsurance for you, but also for Tim. Is reinsurance as a management action a realistic one at the moment? I suspect the answer depends, but any views from you and from Tim?
I'll give a depends. Probably depends on what type of reinsurance you're looking at. So obviously, pandemic reinsurance on a portfolio may not have had a big impact if it was mortality rather than morbidity risk. Obviously, changing reinsurance strategy then, and for a life insurer, then it's really going to be looking at future capital strains. So it may be a replenishment strategy of reducing the strain of writing new business and putting additional reinsurance in an existing portfolio to reduce capital. Yeah, I guess maybe possible, but is a bigger exercise to put in place, and not a quick management action, I guess.
Tim, you work for a reinsurer, what's your view?
So yes, reinsurance is a wonderful strategy, and it's very well priced, and you should come and talk to a company like Swiss Re. It does depend on what you're trying to achieve and how you're trying to do it, but it is a source of capital that you've got to compare against your other sources of capital. If you want to go down the route of a large quota share, that's kind of the obvious one. I think reinsurers, and they've been very conscious that a pandemic risk is not a risk that diversifies globally, and therefore it's limited. You know, the balance sheets of the big reinsurance or risk transfer capital providers can only take a limited slice of this. It cannot take pandemic around the world, and it has done everything it can to, like the insurance policies, to limit that, because it's just not diversifiable or tradable. So working with governments around a public-private pool partnership type idea is the best we can do. But for capital, for as Daniel said, for a quota share for your traditional business that has pandemic exclusions, it is something that can be very helpful, yes.
And I think it's also the same as Paul's comment. You should consider all of the routes to raising capital you have in your plan, and some of them will be more available than others depending on how the whole market is impacted. So raising capital from the debt market or from the equity market would have similar kinds of reactions. There's a limited level of availability, but there will be some there, and it'll be at a price that depends on how much you need it.
It's probably a different, reinsurance capital is probably more attuned to your business needs and probably a bit more flexible, so that, you know, it's not a one-stop 500 million capital raising. If you put out a quota share and you write more or less business, it kind of reacts a bit more consistently with your needs. That's the main difference.
We'll come back to your A, B and C, Daniel. Everyone likes your example A, B and C. Will the shareholders be able to differentiate between those A, B and C? I think this is probably where we start getting into conversation about when's your year end. But what's your view on that one?
Again, yeah, in terms of level of disclosure, and obviously the full ICAP plan is not disclosed, so it comes down to a reporting date, what's disclosed in there, and also what's disclosed in the risk management commentary in the financial statements, which it will be interesting to see as people go through year ends in the current process, what additional level of disclosure is put in around sensitivities to key assumptions here. I suspect there'll be more than there usually is, or additional sensitivities which may be put into the financial statements.
Yeah, and I imagine that there'll be further discussion with auditors as well as actuaries about what's the appropriate way to deal with all three of those levels that we talked about. Another question, which is back to disability income insurance. If insurers don't adjust market margins or target surplus, is there a risk that APRA may go down the route of prescribing industry-wide margins? Before I ask you to answer that, Danielle, I probably should draw everyone's attention again to the Pandemic Resource Centre. There's another paper that's just gone up today, I think, which is actually looking specifically at what kind of assumptions you might think about making in a disability environment, and having a look at that just shows you how uncertain we still are about what might happen. But Daniel, any thoughts on adjustment or not, and the regulator's response?
I can't really comment on the regulator's response. So my expectation is obviously for any session around pandemic impacts on life insurance, then impacts on morbidity assumptions is a key topic. So I'd be surprised if there's a company out there that isn't looking at that. And in terms of their ICAP plans and capital management planning, actually looking at different scenarios. I mean, again, in terms of the potential capital impacts, then it probably comes down to the sensitivity of the capital position of particular insurers, which will depend on their business mix. And in particular, and one particular item which could have a significant capital impact here is how close, in terms of the key driver of capital, how close an insurer is to, if it's currently termination value that is a dominant driver of capital versus a stress projection liability, and whether changes in morbidity assumptions here could actually flip that position, then you'd expect companies to be looking at that closely. So, you know, any particular inflection points like that are going to increase the sensitivity and importance of you know, forming views on what a appropriate level of best estimate assumptions would be, and then the appropriateness of the ICAP framework and everything we've talked about, the sensitivity testing, the capital forecast and scenario planning around potential future outcomes here, and that the monitoring point. So again, the level of prudence put into best estimate assumptions would influence the level of frequency of monitoring and the sort of information points that you're looking for both internally and externally to determine the actual path that you're on.
I think it's important to say here that we would very much expect that regardless of the choice you made about where to hold those margins, every company would be considering a range of outcomes of disability income insurance. And that's the key point here, that it's important to understand the interactions of your scenarios and how much capital you are likely to need in each of them. Tim, any comment from a GI perspective on the risk margins approach on the GI side? It's a little bit different in GI because it's more in your in your underlying liabilities than the regulatory capital position.
Don't know whether you can say that. So,
yeah, it's a bit of both, sorry.
Again, I'd come back to the statement that you'd pick your scenarios on which you're doing your numbers, you'd look at the outcomes in all the other scenarios, you'd stretch maybe your best estimate and your risk margin because of the outcome in those range of scenarios. You know, one of the scenarios that was playing out very early on is business interruption and pandemic exclusions, and whether COVID was physical damage to a property, which is the general kind of exclusion, and that was trying to get eroded. So there was a real threat to contract wording and contract certainty across the globe. Now, the logical outcome of this was, in my view, very curious, because it would have just actually put the whole insurance industry into insolvency in about 2.5 months. The capital relative to the lost business income, it just was ridiculous. And so that seems to have watered down a bit. But that was a realistic scenario that could have played out with the politics that was going on in America, across some parts of Europe as well. So it was less than a 1 in 200 year probability, is my sense at the time. Thankfully, common sense has played out. So I just don't know how you describe that or allow for it in your approach. So it hasn't answered the question. It was just an observation.
I think it comes back to what you said earlier. The more we talk about the range of outcomes and what we would do in each outcome, and actually think about them before they happen rather than as they happen. Yeah, prepared we will be.
Thank you.
But it's important that the users of the financial statements, whoever they are, understand how that's been done. So simpler if you've got an individual shareholder, if you're a subsidiary of another entity, much more complex if you're listed, I expect. One final question from the Q&A, and then I'll ask each of the panelists if you've got any other final comments. How do you think pandemics should be treated in the future? 1 in 250 or more often? How does this impact OAVR?
So again, that's the subject of lots of discussion. So it's in general insurance, the OAVR is, for any non-general insurance, is other accumulations vertical risk. So it's an amount of capital that you need to hold for your non-natural catastrophe explosion on your balance sheet. You could, or on your liabilities, you could phrase it that way. We're doing a lot of work around the APRA wording, which says one dependent source. And so actually in general insurance, we are associating the fiscal monetary government response to the pandemic as one dependent source. So it's the pandemic and the associated economic environment is what you should consider in that space. But that economic environment, which in general insurance is playing out as half of the problem, you know, the pandemic's half the problem and then the economic environment's half the problem, or maybe a little bit more, that can be stimulated or triggered by a GFC or the Great Depression or other kind of triggers. So I think you keep that in mind. But the pandemic is clearly, today's pandemic is clearly much more frequent than a 1 in 200 year event. We've had multiple ones over the last 200 years. So how can you say it's 1 in 200? You can't. So, but what probability is, I'm not willing to say that. So that would be my
any comment on a probability?
I think it's always difficult to put a probability around these events, and I've never been that keen, particularly when you start getting out into the hundreds or even the thousands of, you know, because things have changed so much. And I think if anything, people underestimate the probability of these events. Okay, any final comments from our panelists? Daniel, do you want to start, or comments on your probability of pandemic?
I'm not going to put a probability on the pandemic. I think it links into a broader comment here that the whole feedback loop from an ICAP is what's important here in terms of looking at, you know, did the scenarios you contemplated, did this one fit? Did this one actually play in terms of what you decided to do, what trigger events you had, what actions you contemplated? Did they actually fit with your risk appetite? And is it lined up? And the ICAP is an evolving document. There's got to be that feedback loop. Every year you review the scenarios, contemplate whether you've got them right, that they set at the right sort of levels. And there's, you know, at the end of this year, there's going to be a hell of a lot more information, both locally and globally, in terms of feeding into the scenario planning and the scenarios you test.
Thanks, Daniel. Tim, any final comments from you?
I think the note contemplates what APRA really wanted, that ICAP is just such a fundamental part of managing insurance and a banking entity. So the combination of financial risk management, capital management, and how you bring it together and build the relationships, that's what ICAP's about. Let's use it during this circumstance as well.
Thanks, Tim. Paul, anything from you?
Yes, I agree with that. The only other thing I'd say, and it's not really specifically about ICAP, but there's a danger with all these things, and we do need to do more around managing pandemic risk, that you take the eye off the ball in terms of other risks. Because I suppose coming out of the GFC, we focus a lot on the GFC type risk. We'll come out of this, we'll focus a lot on the pandemic type risk. But you know, what else is out there? And keep your eye on that as well.
Yeah, there's always something else that could be just around the corner.
Yeah.
So with that, I'd like to thank the panelists, Paul, Tim and Daniel, thanks very much, and also the Institute staff behind the scenes, Sarah and Zoe. Thanks very much, everyone, and I hope you enjoyed our session on capital and COVID-19. Be careful with your scenarios. Thank you very much.
Cheers.